Hi, my name is Summer Broadhead. I'm a CPA and one of the financial advisors here at Everthrive Financial Group. It's officially tax season, so I wanted to create a quick video of a few useful tips and highlights from the one big beautiful bill that may impact you. Here are a few key items that you may or may not already know. Typically, partnerships and S corporations have a tax deadline of March 15th, and individuals and single member LLCs, corporations, sole proprietors, they have a tax deadline of April 15th. Now, this does include the tax payment. So, if you owe, extending your return does not extend payment. So, do keep that in mind that even if you extend the filing of the returns, the payment is not extended. Now, for those interested in contributing to their traditional IRAs or their Roth IRAs, you do have until the April tax filing deadline to do so. And as a reminder, the 2025 limit is $7,000 if you are under the age of 50, and it is $8,000 if you are age 50 and over. If you decide you would like to make a contribution to your traditional IRA, you do get a tax deduction for doing so. But there are some special income limits and other rules associated with that. So if you're questionable about your specific situation, don't hesitate to give us a call. We can review and see if there's any limits for you. Now, for those that are self-employed or they end up just owing every single year, you may be thinking, well, I'll just, stroke the check to the IRS come April and I'm not going to worry about it. Waiting to pay the IRS could mean for you that the IRS will potentially assess underpayment penalties and unnecessary interest if you're not paying them throughout the year. So the IRS has a pay-as-you-go kind of system and rule in place. And so if you're not paying as you go, they will potentially assess some penalties. So ways to combat this is just to pay quarterly tax estimates or potentially adjusting withholdings on other sources. And lastly, I wanted to touch base on some key highlights from the new One Big Beautiful Bill that was passed last July. I just wanted to go over a few highlights that may or may not impact you. There's many more, but I just want to touch base on a few. So, the increased standard deduction in 2025 increased, and for single filers, the amount is $15,750. And for married individuals filing jointly, the amount increased to $31,500. The SALT deduction, which is the state and local tax deduction, it was previously capped at $10,000, and that cap has increased to $40,000. The new senior deduction, this is a temporary $6,000 deduction per taxpayer for those that are 65 and older. And there are some income limitations. So if you're under or over the certain income limits, that amount can be reduced. And then it's fully eliminated if your income is over $175,000 for single taxpayers or over $250,000 for married taxpayers. Another new one is no tax on overtime and tips. So for the overtime, the new deduction is up to $12,500 for each taxpayer. And then the no tax on tip deduction, this deduction is up to $25,000 per taxpayer for qualified tips received by an individual in an occupation that customarily and regularly receives tips. Both of these deductions are phased out for single taxpayers with income over $150,000 and for joint taxpayers with income over $300,000. And these deductions will both be eliminated in 2029. The child tax credit, this increased to $2,200 per child. And beginning in 2026, there is a new above the line charitable deduction available for taxpayers who take the standard deduction. Charitable contributions can be deducted up to $1,000 for single taxpayers and up to $2,000 for married couples filing jointly. Now, if you do itemize, you will face a new limit, and this includes charitable contributions cannot be deducted unless you have to exceed at least 0.5% of your adjusted gross income. And then for 529 plans, there are qualified expenses that now include post-secondary credentialing expenses. And more expenses will be added to the list of elementary and secondary school qualified expenses in 2026, such as materials and books, as well as tuition for tutoring and education classes outside of the home. And lastly, the Trump accounts. The One Big Beautiful Bill created special IRAs for children that are under age 18. Contributions can be made in the calendar years before the beneficiary reaches age 18. A distribution of the funds can begin in the year basically that they reach 18. Again, subject to some rules that I'm not going to fully disclose here, but just know there's other rules associated with this. And there's also $1,000 contribution offered for eligible newborns. So eligible newborns would be children born between years 2025 and 2028. The bill also allows for employer contributions to the Trump accounts. These contributions would not be included in the employee's income. And then the investment options for the accounts appear to be limited to mutual funds and exchange traded funds that track the S&P 500 or another qualified index. And there are many, many more. These are just a few that I wanted to call out. So thank you so much for your time. I hope this video offers valuable insights and considerations for the upcoming tax season.